Warren Buffett does not just pick stocks, he builds conviction-driven portfolios. In this episode of PortfolioCasts, we break down Berkshire Hathaway's current portfolio, major holdings, concentration strategy, and the investing philosophy behind it. Looking at a $280 billion portfolio is always a masterclass in discipline, but seeing it down 1.03% today reminds us that even the greatest aren't immune to market fluctuations. Mike, when we look at the top of the pyramid for Berkshire Hathaway, the concentration is staggering. Nearly 23% of the entire portfolio is sitting in just one name, Apple Inc. What's your take on the recent movement there?
It's the definition of a core holding, Sarah. Even though we saw a significant reduction of 14.92% in the position recently, Apple Inc. remains the crown jewel at 22.7% of the total portfolio. We're talking about 238,212,764 shares. At a current price of $272.52, that position is worth over $64.9 billion.
And despite that trim, the overall gain is still sitting at 7%. But looking at the fundamentals, a P/E ratio of 36.0 feels a bit rich for a classic value play, doesn't it? Especially with a dividend yield of only 0.32%.
It does, and that might explain the 14.92% reduction. Buffett is known for buying wonderful businesses at fair prices, but at a 36 P, the fair price argument gets harder to make. Technically, it's trading near the top of its 52-week range of $169.21 to $288.62. It's slightly down today, about 0.2%, but the sheer scale of the $64 billion position means even a small move impacts the total portfolio significantly. There's some chatter in the news about the Vanguard Dividend Appreciation ETF potentially outperforming other high-dividend funds by 2026, which is interesting because Apple is a staple in those growth dividend conversations despite the low current yield.
Let's shift to the second largest holding, which is American Express Co. This one feels like a classic Buffett forever stock. It accounts for 18.8% of the portfolio, and interestingly, there were no recent changes to this position.
Exactly. It's a $56.4 billion vote of confidence. Unlike the trim we saw in Apple, American Express Co. was left untouched. It's currently trading at $372.09, and the performance has been stellar. The portfolio shows a 12% overall gain on this position. With an earnings per share of $15.08 and a P/E ratio of 24.5, it's a bit more reasonably priced than Apple, though still on the higher side for a financial.
I noticed it's also hovering near its 52-week high of $387.49. With the news cycle focusing on a new era for Berkshire as Buffett steps back from some of the day-to-day spotlight, keeping such a massive, stable stake in American Express Co. sends a strong signal about the durability of that business model.
It's that durable competitive advantage he always talks about. The dividend yield here is 0.88%, which isn't massive, but when you own 151,610,700 shares, those checks add up. It's a cornerstone of the financials segment of the portfolio.
Speaking of financials, we have to talk about Bank of America Corp. This is the third largest holding at 11% of the portfolio, but we've seen some active selling here. They reduced the position by 6.15% recently. What do you see in the numbers?
Bank of America Corp. is a different beast entirely right now. It's valued at $31.2 billion in the portfolio, but that 6.15% reduction is notable. It's currently trading at $55.02, which is right at the top of its 52-week range of $33.06 to $56.55. What jumps out at me, Sarah, is the P/E ratio of 13.6. That is significantly lower than Apple or American Express.
And look at that dividend yield, 6.82%. For a company with an EPS of $3.84, that's a massive yield. Why do you think he's trimming a position that seems to fit the value criteria so perfectly?
It's a bit of a head-scratcher if you only look at the yield, but the 6.7% overall gain suggests they might just be taking some profits off the table while the stock is near its 52-week high. The daily change was down 0.46%, contributing to that overall portfolio dip today. There was an interesting piece of news regarding Gen Z's future wealth tracking to become the richest generation in 10 years, which bodes well for retail banking long-term. but Buffett often looks at the macro environment for banks.
It's fascinating to see the contrast. You have Apple at 22.7% with a high PE, American Express at 18.8% with steady growth, and Bank of America at 11% with a massive dividend, but a recent trim. These three stocks alone make up over 50% of the $280 billion total.
It's extreme concentration. When people think of diversification, they don't usually think of putting $64 billion into one tech company and another $87 billion into just two financial institutions. But that's the Buffett way: conviction over diversification. Even with today's 1.03% drop, the portfolio is still up 4.7% overall. He's playing the long game with these three pillars.
The Bank of America yield of 6.82% really stands out when you compare it to Apple's 0.32%. It shows he isn't just chasing one type of return. He's balancing that high-growth tech exposure with heavy-hitting cash flow from the banks.
And even with the recent trims in Apple and Bank of America, the sheer volume of shares, 568 million shares of Bank of America alone, shows that these remain core by any definition. They aren't exiting, they're calibrating.
Moving on to what many consider the quintessential Buffett stock, we have to talk about Coca-Cola. It's sitting at number 4 in the portfolio, representing 9.9% of the total value. Mike, even with the market being a bit choppy today, Coca-Cola seems to be holding its ground relatively well, doesn't it?
It really does, Sarah. Coca-Cola is currently trading at $69.99, and while it saw a minor daily dip of 0.11%, the long-term story remains incredibly stable. Buffett is holding exactly 400 million shares, which carries a massive market value of $27.996 billion. What's interesting here is the fundamental profile. We're looking at a PE ratio of 23.1 and a dividend yield of 2.91%. It's the classic dividend aristocrat play, and in fact, recent news highlights it as one of the best dividend aristocrats for January 2026.
And looking at that 52-week range of $60.62 to $74.38, it's trading toward the higher end of that spectrum. Is there any concern about the valuation there?
With an EPS of $3.02, the valuation is fair for a company with that kind of global distribution moat. Buffett hasn't made any recent changes to this position, which signals total confidence in that 5.5% overall gain he's sitting on. Now, if we shift gears to the energy sector, we see a very different dynamic with Chevron and Occidental Petroleum. Chevron is the 5th largest holding at 7.1% of the portfolio, worth over $18.5 billion.
Chevron is interesting because, like Coca-Cola, it's also being tagged as a top dividend aristocrat for 2026. But the performance has been a bit more muted, right?
Exactly. Chevron is down 0.2% today, trading at $151.99. Buffett's overall position is actually down 2.1%. However, the 4.49% dividend yield is a huge draw here, especially with a PE ratio of 23.9. It's a massive position of over 122 million shares. But Sarah, look at Occidental Petroleum right behind it. That's 4.7% of the portfolio, worth $10.875 billion, but it's been a rougher ride.
You're not kidding. The data shows an overall loss of 13.1% on that Occidental position. With the stock at $41.05, it's actually creeping closer to its 52-week low of $34.78. Why do you think he's sticking with it despite that double-digit loss?
It's about the long-term cash flow and the management. Even though the daily change was a drop of nearly 1% today, the PE ratio is quite attractive at 19.4. He's holding over 264 million shares. It's a conviction play. Speaking of conviction, we have to look at Chubb Limited. This is a standout because he actually added 15.90% to the position recently.
That's a significant move for a 3.3% allocation. Chubb is trading at $313.41, which is right at the top of its 52-week high of $314.68. Mike, he's already up 11% on this. What's the catalyst?
The fundamentals are just stellar. Chubb has a PE ratio of only 12.8 and an EPS of $23.95. Recent news shows they beat revenue expectations for the third quarter of 2025. It's a high-quality insurer, which is right in Buffett's wheelhouse. It's currently worth $9,820,000,000 in the portfolio.
Now, let's talk about some of the supporting positions that add that extra layer of diversification. Moody's Corporation is a 4.4% allocation, worth $12.6 billion. It's got a much higher PE ratio than the others we've discussed, though.
It does, at 41.0. Moody's is trading at $514.49. While the dividend yield is low at 0.73%, the overall gain for the portfolio is 8%. There's been some news that their 3-year earnings growth is trailing shareholder returns, but Buffett seems content to hold his 24.6 million shares steady.
Also worth noting is the tech and consumer side of the supporting cast. I was surprised to see Alphabet Inc. on the list with a recent buy activity. It's 1.6% of the portfolio, worth about $5.5 billion.
That's a very interesting addition. Alphabet is trading at $313.28, and Buffett is already up 28.9% on it. With a PE of 30.5 and news calling it a top 2026 pick, it shows that even at 94, Buffett is willing to lean into big tech when a moat is clear.
And we can't forget the yield plays like Kraft Heinz, which has a massive 6.55% dividend yield, and SiriusXM, where he recently added 4.20% to his position.
SiriusXM is a value play if I ever saw one. A PE ratio of only 6.9 and a 5.26% yield. Even though he's down 13.6% overall on that one, the recent ad suggests he's doubling down on the value proposition at $20.10 per share. It's these smaller, 1 to 3% positions that really show how he's balancing high-yield income with steady growth.
Now, let's look at some of the positions that might not get the same headlines as Apple or Coca-Cola, but they tell a fascinating story about how the Berkshire team is viewing the current market. I want to start with VeriSign Inc. Mike, this is sitting at about 0.9% of the total portfolio, but I'm seeing a pretty massive shift in the recent activity data. What's going on there?
You're right to spot that, Sarah. VeriSign is currently a $2.19 billion position for Buffett, with just under 9 million shares. But the headline here is that they recently reduced this position by 32.36%. That is a significant trim. When you look at the fundamentals, VeriSign has a price-to-earnings ratio of 28.1 and an earnings per share of $8.59. It's a very steady, almost utility-like business model in the tech space. But with the stock down 0.9% today to $243.70, it's actually sitting in the middle of its 52-week range of $199.54 to $310.60.
And the overall performance for them hasn't been great, right?
Exactly. They are looking at an overall loss of 12.8% on that position. Even with a dividend yield of 1.25%, it hasn't quite lived up to the buy and hold ideal lately, which might explain why we saw that 32% reduction. They might be losing a bit of patience or simply finding better places to park that capital.
Speaking of parking capital, let's move on to Constellation Brands Inc. This feels like a classic Buffett mode play, even if it's a smaller slice of the pie.
It really is. Constellation Brands represents 0.7% of the portfolio. They hold 13.4 million shares, which is worth about $1.85 billion. Now, unlike VeriSign, there's been no recent activity here. They are holding steady. The stock is at $138.72 today, down about 1%. What's interesting here is the valuation. The PE ratio is a very reasonable 19.9, and you're getting a nearly 3% dividend yield, 2.91% to be exact.
And they are actually in the green on this one?
Just barely. They have an overall gain of 3%. If you look at the 52-week range, it's topped out at $228.89. So, at the current price of $138, it's actually trading much closer to its yearly low of $126.45. It looks like a value play that they are just waiting on.
Now, I have to ask about Capital One Financial Corp. Looking at the data, the price-to-earnings ratio is jumping out at me. Am I reading this right? A PE of 109.8?
You are reading that correctly, Sarah, and it is definitely an outlier for a Buffett holding. Usually, he's looking for much lower multiples in the financial sector. Capital One is a 0.6% allocation, about $1.74 billion in value. Despite that high PE ratio, the position is actually up 14.9% overall. Today it's one of the few green spots in the portfolio, up 0.14% to $244.30.
That's interesting, because it's trading right near its 52-week high of $249.73. Why hold on to a bank with a triple-digit PE?
Well, the EPS is $3.05, and while the PE looks inflated, Buffett clearly sees something in their credit card and lending business model that justifies the hold. They haven't touched the 7.15 million shares recently. It's a wait-and-see approach while sitting on a 15% gain.
Let's shift gears to healthcare. United Health Group Inc. is in the portfolio at 0.7%. This is a massive company, but the position size here is about $1.66 billion. How is that performing?
It's been a bit of a struggle. They are down 4.2% overall on United Health. The stock is currently at $330.89. If you look at the technicals, the 52-week range is huge from $234.60 all the way up to $606.36. So, we are currently seeing it trade at almost half of its yearly high. However, the fundamentals still look like a Buffett stock, a PE of 17.2 and a solid dividend yield of 2.66%.
It feels like a lot of these mid-tier holdings are currently in the red or just breaking even. Is that a concern?
For most investors, maybe. For Buffett, it's usually an opportunity. Look at Aon plc, 0.6% of the portfolio, worth $1.45 billion. It's down 0.3% overall, almost perfectly flat. Or look at Domino's Pizza Inc. Now, this is an active one. They actually added 13.22% to this position recently.
Wait, they added more Domino's? Even though it's down?
Yes. They now hold nearly 3 million shares worth $1.24 billion. Even though the position is down 3.3% overall and the stock dropped 1.1% today to $117.27, they are buying the dip. It has a PE of 24.2 and an EPS of over $17. Buffett clearly thinks the market is underestimating the pizza delivery giant.
It's also worth noting Nucor Corp. This is a smaller position at 0.3%, but the returns are fantastic.
Nucor is a standout. They are up 20.2% overall on that steel play. Interestingly, they did reduce the position slightly by 3.12% recently. They are likely just shaving some profits off the top. It's a $1 billion position now, with the stock at $162.74. When you see a 20% gain in a cyclical industry like steel, a 3% trim is just good portfolio management.
We also see some exposure to the sports and entertainment world through the Formula One group. They have two different share classes here, LIVC and LEVA.
Right, and these are tougher holds right now. The larger position, LIVC, is worth about $902 million and is down 14.8% overall. The PE ratio there is a staggering 144.3. It's a very different kind of valuation than what we see with something like Lennar Corp, the homebuilder, which is also in this tier. Lennar has a PV of only 9.7.
And they actually added a tiny bit to Lennar recently, right? 0.03%?
A very marginal add, yes. It shows they are maintaining their conviction in the housing market despite Lennar being down 18.1% overall. It's all about that long-term horizon. Sarah, when you look at these holdings from VeriSign down to Lennar, you see a mix of aggressive trims in tech and steady accumulation in consumer and industrial sectors.
Mike, we've spent a lot of time today talking about the titans of the Berkshire Hathaway portfolio, the Apples and the Coca-Colas that everyone knows. But as we head into the final minutes of our analysis, I want to look at the tail of the portfolio. These are positions that often make up 0.1% or even 0.0% of the total $280.0 billion, but they offer a window into the more specialized or perhaps more experimental side of the Oracle strategy. Let's start with HEICO Corp. It's a 0.1% allocation, currently priced at $253.59. What does this tell you about their appetite for the aerospace and electronics sector?
It's a fascinating inclusion, Sarah, especially when you look at the valuation. HEICO Corp has a PE ratio of 61.4, which is significantly higher than your typical value play. It's currently sitting at $253.59, which is toward the lower end of its 52-week range of $216.68 to $340.11. Despite a small daily drop of 0.56%, the position is relatively stable with an overall loss of just 0.2%. What's interesting here is that even with an earnings per share of $4.56 and a tiny dividend yield of 0.07%, they are holding steady with 1,294,612 shares. It's a specialized business, and it shows that the Berkshire team is willing to pay a premium for high-quality, niche engineering firms.
Speaking of high valuations, I have to bring up Formula One Group. That PE ratio is eye-watering at 144.3. They hold about $297 million worth of it, which is again just 0.1% of the total. It saw a slight gain today of 0.27%, ending at $98.47. Mike, is this just a fun bet, or is there a deeper logic to holding a sports media property that's currently down 5.7% overall for them?
Well, Formula One Group is a unique beast. Its 52-week range is $68.00 to $99.52. So, at $98.47, it's actually trading right near its yearly high. The high PE reflects the growth expectations of that global brand. It's a classic moat business. There is only one Formula One. However, if we look at the broader communications and media bucket, the story is a bit more somber. Look at Charter Communications Inc. That's another 0.1% holding, but it's been a rough ride. The current price is $209.12, and the overall loss on that position is a staggering 24.0%.
24% is a heavy hit, even for a small position. But the fundamentals there look completely different from Formula One, don't they?
Exactly. Charter Communications Inc. has a PE ratio of only 5.8 and a massive EPS of $37.00. It's a value play that hasn't unlocked its value yet. It's currently trading near its 52-week low of $193.00. On the flip side of the media space, we see Lamar Advertising Co. This is one of the few spots where we saw recent activity. They actually added 2.79% to this position recently. It's currently at $126.51 with a healthy dividend yield of 4.89%. That 3.3% overall gain shows that their bet on outdoor advertising is actually outperforming their cable and satellite bets.
I find the housing and industrial plays in this lower tier really telling. They have NVR Inc., which is a massive $7,317.02 per share. Even though it's technically a 0.0% allocation, because the position size is only $81 million, it's a high-conviction type of business model with an EPS of $455.53. And then there's Lennar Corp., the Class B shares. They recently added a tiny bit there, 0.03%, bringing the price to $95.66. Mike, Lennar is down 20.3% overall for them. Why add more now?
It's likely a move to average down or a sign of long-term confidence in the housing market despite the current 20.3% loss. Lennar Corp has a very attractive PE of 9.7 and a dividend of 1.93%. When you look at the 52-week range of $98.42 to $144.24, you can see it's currently trading below its 52-week low, which is often when the Berkshire team likes to nibble. They're looking at the $10.23 EPS and seeing a company that is fundamentally cheaper than the market realizes.
Before we wrap up, we have to mention the rounding errors, the positions that are so small they barely register, like Diageo plc and Jefferies Financial Group. Diageo is at $86.43 with a nearly 5% dividend yield, but it's down 9.4% overall. And Jefferies is at $62.31, down 4.8% overall. Then you have the sports and international plays like Atlanta Braves Holdings, down 5.2% overall, and Liberty Latin America, which is down between 11.9% and 12.5% depending on the share class. It seems like this entire bottom section of the portfolio has been under some pressure lately.
It really has, Sarah. When you look at the total portfolio change today, it's down 1.03%. While the overall gain is still positive at 4.7%, these smaller positions show that even the best in the world have underwater bets. But that's the lesson. Buffett and his team don't panic. Whether it's Allegiant plc at $160.64 or Jefferies at $62.31, they hold through the volatility if the business case remains.
That's a perfect place to leave it. A $280 billion portfolio isn't built on 100% wins, it's built on a few massive winners and the discipline to manage the rest. For Mike and myself, Thanks for joining us on this deep dive into the Berkshire Hathaway holdings. We've covered the giants and the niche players, and as always, the Oracle of Omaha continues to give us plenty to analyze. Follow PortfolioCasts for more investor portfolio breakdowns. We'll see you next time.